Next week, Rachel Reeves will deliver her first budget as Labour Chancellor. If you read the news, it's all doom and gloom.
But if you're a landlord, it's not necessarily the case. In today's episode of the Property Tax Show, I'll be talking to Nadeem, Head of Tax here at Provestor, who's going to share the 3 trends that he's learning about from property investors and who's getting ready to invest in 2025. Hello, I'm James Poyser.
And I'm Nadeem Razik, Head of Tax here at Provestor, the Property Accountants.
With Rachel Reeves' budget on the horizon next week, looking at the news, there is speculation about what the impact is going to mean for landlords when it comes to tax. And that's what Nadeem and I are going to be chatting about today. So we're going to run through the top 4 rumours we've heard about tax and what landlords need to do to respond. Plus, Nadeem is going to give the insights that he's learned chatting to property investors who are preparing to invest in 2025. So Nadeem, there's the 4 top things that are coming up about next week's budgets. SDLT, inheritance tax, employers' national insurance, and capital gains tax. So let's first start off by quickly going through these and what the impact's going to be for landlords. So stamp duty for non-residents?
Yeah, so 4 tax things, which, as people will know, things have been changing all the time in terms of what the potential announcements are going to be. Mm-hmm. One of the tax changes that we've heard about is potentially stamp duty for non-residents. So as some of our listeners will be aware of already, there's a 2% surcharge for non-residents. Yep. If you meet the non-resident ruling for stamp duty purposes, which is not to be confused with non-resident statutory rules. And if you fall within that non-resident 2% surcharge, the chances are it's going to be increased by another percent. So that's going to go to 3%.
Okay. So that's people who currently live overseas, looking to invest in the UK, will have to pay an additional bit of stamp duty.
Surcharge, yeah.
But if you're a UK-based investor investing in the UK, no change.
No change.
Okay, good. That's quite straightforward. Inheritance tax. Been a lot of chat about inheritance tax around rates and allowances and how that could impact landlords. Do you want to tell us more about that?
Again, this has been going around for a while in terms of inheritance tax, and we appreciate it's not specifically for landlords in terms of how it'll impact you, but it does impact everybody in terms of inheritance tax. And the rumours are that they are going to increase the inheritance tax rate of 40% to higher, whether that's going to be 45% or even 50%. And then they are potentially going to reduce the nil rate band as well. So at the moment, every individual has a nil rate band of £325,000, where if your estate is below, there's no inheritance tax charge. There's rumours that that's actually going to be reduced.
Right.
So more people getting caught with an inheritance tax charge.
Okay. And I also hear that they're thinking about capital gains tax at the same time for inheritance as well.
Yeah, so potentially duplicating inheritance tax charge as well as a CGT charge on certain assets that get passed over on.
So there could be a double tax duty on death for right. Okay, and what does this mean for landlords?
Well, what this means for landlords, James, is actually what we've been talking to our landlord client base for a long while, which is actually understanding how important inheritance tax planning is. Because as we know with properties, it takes 1 or 2 properties and you're over that £325,000 nil rate band, and you're very quickly having a very big IHT exposure. So we've always talked to clients about having that long-term vision insight in terms of having inheritance tax planning or something in place where your estate planning is being looked at. And it's one of the things people don't like to talk about. And it's kind of the back of the agenda type thing. And this has very, very much brought the conversations to the forefront over the last few weeks.
So do landlords actually have options then when it comes to inheritance tax and planning?
There is. There's lots of options available, whether that's assets in your personal name, assets in a limited company, assets in a trust.
Okay.
Some options are quite expensive,
right.
But actually the savings to be had are huge. So a lot of people who do high net worth people will, of course, do these types of kind of investment strategies where they can move their assets into a more estate-friendly manner. Where we find is people who kind of are more focused on actually increasing their asset build or their portfolio, and they kind of just push the inheritance tax side to the back of their to-do list type thing.
Yes.
But yes, there are options out there.
And I guess that's the thing, you sometimes forget property, think about the value of your portfolio over a couple of decades and where that can get to, and the impact on inheritance tax can be really significant. But it sounds like we tend to think about inheritance tax planning as the preserve of the very, very wealthy. Yeah. But actually it sounds like it's more accessible than ever to think about inheritance tax planning. Probably just reach out to a tax advisor, right?
Exactly.
Like you and your team, and have a chat about what the options are.
Yeah. And with properties, again, as our listeners will know, it's that it just takes 1 or 2 properties. You very quickly get yourself in that boat of having exposure. It's not like you're building a business up and it will take a few years to get to the value of £325,000.
Yes.
Properties, businesses, have value very, very quickly. Yeah.
Okay. Good. The third one now, tell me, is this a red herring or not? National insurance for employers and how that could impact landlords. I've seen a bit of that in the press. What's your view?
I mean, it's not a red herring in the sense that it's a real thing. So it's the employer's national insurance rate, which is going to increase from 13.8% to what they say another percent of 14.8%. So it's an indirect cost, ultimately, potentially to an employee.
Yeah.
So yes, it could affect some of our landlords who remunerate themselves through their limited companies, and all of a sudden they have now their employer's liability is going to increase.
Yeah.
Again, there are ways to mitigate that depending on how much you pay yourself, how you pay yourself. So get a bit of advice, but that's not something that's going to.
So that's only going to impact. So just to get this straight, so this is landlords who are using limited companies, who are paying themselves a salary from their limited company, and the employer's national insurance part of that, which is only payable if it's a salary above
their threshold.
Their threshold.
Employer's threshold.
That's the bit that'll be impacted. So there's actually very few landlords who'll be impacted by that.
And what I would normally say, James, if you were working for a company, the employer's national insurance wouldn't be your worry. That would be the company who'd pay that for you on your behalf. But because you are the director of your company who's paying yourself, of course, that liability falls on you as the director of the company. So yes, we have to consider employers' national insurance. So yes, that's just something for anyone who pays themselves through their limited company. Yeah.
Great. And finally, the big one is capital gains tax. Now, if you've been following the news, it's been all over the place. It's been sending the property investment sector absolutely wild, with talk of aligning the capital gains tax rates with income tax. Is that right, Nadeem?
Yeah.
I think the latest we heard in the Telegraph last week, they've reported that they believe that if the Chancellor does increase the rates, there's going to be an exemption for landlords. Over to you, Nad. Help us to understand what this means.
Yeah, so as you'll know, or as you may well know, there are two rates to consider when we're talking about capital gains tax. One for general disposals of shares or assets, which are normally 10%, 20% basic rate, high rate. For landlords, anyone with residential property who's selling those properties, the capital gains tax rates are different. So you have an 18% basic rate threshold and 24% if you're a high rate. And those are the ones you're talking about, which actually the rumours are they may not change. But actually for the last 4-6 weeks, there's been a lot of hot talk about actually aligning capital gains tax with income tax rates, which are currently 20%, 40%, and even 45%.
Right. Okay.
So you could see where that's created a lot of uncertainty because people have thought where they might be 24% or 20% as a high rate taxpayer, all of a sudden you're now paying 45%. And when you're talking about properties, you're talking about a huge amount of tax on the capital disposal.
Yeah.
So we've been having a huge amount of calls and consultations with people who are wanting to plan in terms of understand what that means for them personally, planning in terms of timing and in terms of how to do these things properly, because there's a lot of things selling a property isn't easy. It can't be done overnight. Things have to be done in order. So that there's been a lot of conversations, a lot of planning with clients to just put their minds to ease in terms of what this budget's about to bring.
Yeah. Okay. I'll come back to that in a second, actually, because I know, Nadeem, you've given me the three top things that you're talking about with landlords at the moment. But again, just kind of going back to the market, is that whether or not the CGT change happens, as we thought it was going to happen a few weeks ago, it seems to be there's been a bit of a wake-up call for landlords, particularly for accidental landlords. People are a bit apprehensive, didn't really want to be a landlord anyway, and now they're starting to think about exiting the market. I think there was some Rightmove figures a few weeks ago which pointed to the increase in the number of landlords who are selling properties. And I've got this feeling that whether the CGT thing happens or not, and let's assume that it doesn't, and there isn't going to be a change to CGT, it sounds like it's going to be a big wake-up call and a bit of a near miss for landlords, particularly those who aren't particularly vested in investing, thinking, actually, you know what, now's time for me to step off the bus. So I guess this kind of leads on to the question now about you're chatting to a lot of our clients at the moment. So this time of the year, end of the year is busy because we've got self-assessment season in January. You've got limited companies with December year end, so a lot of clients choose to have a December year end. Plus you've got the budget as well. So you're chatting to lots of people. And you were saying that the doom and gloom that we're experiencing out in the market isn't translating to your clients. It sounds like it's actually quite the opposite. And there's quite a few clients who are getting ready to invest next year. And you mentioned the three themes. I don't know if we just go through those. So the first one that you mentioned, Nat, was a lot of our clients are actually sitting back and starting to cleanse their portfolios. Tell us more about that.
Yeah, I mean, this is something we've talked about clients all the time, that how important it is to actually, look at your portfolio, have a cleanse, look at your sort of weaker performing assets. And you might have heard me saying this a number of times on other shows. It's really important because having a good tax advisor should hopefully not only give you good tax advice, but actually make sure you understand what your portfolio is doing, from a tax and a commercial sense.
Okay.
So we always make sure their bookkeeping is up to date, is accurate, so they can check where those assets are performing well or not so well. And obviously with the changes in tax and legislation and sort of, all the things that have come down over landlords over the last few years, it's really important to keep an eye on sort of those weaker properties. And then the timing of what you do with those properties in terms of retaining them, selling them, incorporating them into a limited company is really important as well. So we've talked about it being a bit of a kick up the backside, because this is ultimately kind of forced some people's hands to think, oh, if something's going to really happen, is now the right time? The answer to that is it's always the right time to be having a look at that. And actually now this might have just made them force their hand somewhat in saying, well, actually, I am going to do it now, because if something does happen with capital gains tax rates, for example, I certainly don't want to be paying 40-45% up tax. So it's made our clients open their eyes up a little bit more, made them understand actually what it means if they would sell it now compared to next year if the rates were to go higher. But yeah, it's nothing new is what I'm trying to say. It's what we actually always advise clients to do.
Yes.
Of course, with changes when it comes to budget or tax rates, it makes people just perk up a little bit more.
Yeah. I think it's a really good point. If you go back and take a look at previous episodes of the Property Tax Show on YouTube, it's a very common theme that Nad talks about. It's not just about considering tax, and property isn't just a once and done thing, buy the property and that's it. It's an ongoing thing to optimize your portfolio. You talk about it, and Nadeem talks about it as commerciality, and making sure that you're looking at which ones are making a profit, which ones are making a loss, which ones are just on the edge.
Yeah.
And thinking if you can free up some capital to reinvest it into something that's going to work.
Yeah, I mean, this time last year we were talking about furnished holiday lets, weren't we?
Yes.
And how great they were and how they were bringing a lot of income into to people's portfolio. And then we did another property tax show recently because of the announcement made in terms of the clampdown on the tax rules for furnished holiday lets and what that means for people. And actually, it just means you, again, being smart about your portfolio and how you're unwinding certain assets. And it could well be that the property itself is great and it's still a good money generating income earner, but maybe just not in a furnished holiday let, and you kind of unwind back to a buy to let. So it's just being a bit streetwise.
Yeah. Okay. Yeah. Great. Thanks. So we've got clients who are looking to dispose of properties, cleansing their portfolios, which leads me on to the next point that you made to me recently, Nadeem, is that whilst we've got clients who are selling properties, a lot of them, well, the majority of them, are selling to prepare to reinvest. And you mentioned to me earlier on today, Nadeem, about how actually with people exiting the market, so accidental landlords getting spooked by the budget, it's creating opportunities, particularly for more savvy investors who realise there's suddenly going to be a lot more properties on the market and more bargains to be had.
Yeah.
So tell us more about that our clients are actually getting prepared to reinvest.
Yeah, I mean, look, we do have a portfolio of accidental landlords, but a lot of our landlords are quite experienced, or they want to become experienced landlords. So when they look at the market and look at the advice that they see out there in terms of exiting or selling because it's not a good time to be a landlord, actually what we find in practice is that those ones who are selling to reinvest. And that's quite a smart thing to do. So we talk about those weaker assets that they're actually disposing of, or moving away from your vanilla buy-to-let properties to commercial or HMOs, but to a different type of business. And actually, start talking about Section 24, where it's impacted a huge amount of personally held landlords, and moving to limited companies. There was a lot of clients who could hold their hand and incorporate. There was a lot who couldn't incorporate without a big tax charge. So one of the options they took was to actually sell but reinvest. So it was never a case of, right, we've had enough. It was kind of, how can we be more smart about reinvesting? And that comes down to sort of, the peaks and troughs, whether it's interest rates or mortgage rates or supply and demand. But we know, with interest rates dropping and people looking at the portfolio being much more tax efficient in a limited company, many landlords now are sort of reinvesting and using that route back into the limited company route.
Yeah, I guess that makes sense, because there might be people who are exiting the market because they're an accidental landlord. They came in when the interest rates were low. Interest rates have crept up. Perhaps they've had to remortgage recently. They're at the mercy of Section 24, and suddenly they've gone from a really great property to something that's now a bit of a dog. Yeah. For them personally, compared to how it was. But somebody taking that same property on via a limited company may actually find there's still a very solid business case for having a property like that in their portfolio. So just because people are exiting a particular property you've got to appreciate their personal circumstances and your personal circumstances to understand the commerciality of it. Is that fair?
Yeah, it is absolutely, because what's right for you in your portfolio may not necessarily be right for somebody else in terms of their portfolio. And we deal with a lot of landlords who, when they're young, they're very ambitious and they're very driven, but then when they come to sort of the later parts of their life and they start thinking about inheritance tax and those other kind of issues, they exit somewhat. They don't completely exit, but it's how you exit from that. And like I say, you sell some of those properties which may be in your personal name or not performing so well, which could be really fruitful for somebody else. But actually, for your personal scenario where you're actually reducing your estate and it works out more tax efficient to maybe get rid of a property, it makes absolute sense.
Yeah. Okay.
Yeah.
So in that, so the conclusion of that second part is then, you might be looking to sell, but also be thinking about reinvesting opportunities, what's going to come on the market in 2025 as other people look to divest, accidental landlords looking to exit. So there's opportunity ahead for certain landlords. Okay, great. And the final point that you told me about this morning was lots of conversations about tax structures. So we're talking about preparing to reinvest, and you're saying part of that preparing to reinvest is also kind of updating your knowledge on tax and tax structures, particularly with limited companies. Tell us more.
Yeah, so again, as we're kind of educating our landlords and our client base, it's almost like if you're reinvesting, you're kind of exiting and going back into a purchase, almost with a bit of a clean slate sort of approach. And these landlords could have bought their first properties sort of 10, 15, 20 years ago, where they kind of didn't know any better, bought property in their personal name, all of a sudden they had 6, and then they've got a tax advisor telling them they've got an inheritance tax exposure and they don't know what to do about it, which is understandable. Whereas if you take a step back now and say, well, okay, I'm about to do this, it's a bit of a clean slate, and you can actually approach your build or your portfolio managing a little bit more smartly, should I say? And using a limited company, there's loads of flexibility. So we talk about you talk about smart structure. You talk about family structures. We talk about actually what are you trying to achieve with this portfolio? You're opening a limited company. Who's going to be involved in this? Is it going to be family members, your partner, your children, your grandchildren? Inheritance tax, again, you can plan and you can create a structure in a business which is going to be future-proof, which you don't have so much control when you're buying properties in your personal name, or you probably weren't even aware of 10 years ago when you started buying properties. So it's, again, a real important juncture where we come to here when we talk about sitting back, re-looking at your portfolio, and then using a limited company, which is really tax efficient now. But it's not just about opening a limited company, it's about actually then making sure you're not in the same position again in 10 years time and trying to unwind things or unpick things, basically.
Yeah, I think we've covered this in quite a few episodes of the Property Tax Show, is that it feels like owning a property in your own name is pretty much a one-trick pony. There's very little you can do apart from something like a deed of trust in terms of tax planning on personal property. But once you move into the world of limited companies, the options to align how you run your company and structure it and what you do on a day-to-day basis, the option to align that with your long-term goals and your strategy to get there, you've got far more levers to pull, as you said. Planning for your kids, planning for your inheritance. Even things like if you're looking to build a portfolio and you want to retain profit in the company, that's something that's really fantastic, how much you can accelerate the growth of your portfolio in a limited versus personal. Because I know lots of people talk about limited companies and the top line being, tax and Section 24. But then when you go to that next layer down, you appreciate that there's so much more to running a limited company and the options that it gives you as an investor.
Yeah, and I guess you only really know the advantages once you kind of really unpick what you're trying to achieve, and then obviously having the right structure in place. It's got to work right for you. It's not having a company in place which is just sort of off the shelf type thing. It may not be the right thing for you. So if you can get it really, structured in a way which is going to meet you and your family's needs, it's great for tax efficiency.
Great. And we've just done a free pro masterclass on limited companies. So if you're new to limited companies, we've got a 10-lesson pro masterclass which basically teaches you everything you need to know, from what it is, why you should use one, how to structure it, right through to things like banking, mortgages, and successfully running a limited company. I'll put a link in the description below for that, completely free, or head over to the Provestor website and you'll find it on there. Whilst we're on that, actually, if you've got any questions for Nad on the upcoming budget, put them in the comments below. It's only a few days to go, but we'll try really hard to get your questions answered over the next few days. Okay, great. So it feels like what we've covered, Nad, is the 4 top line things for the budget. So it was, remind me, it was IHT,
National insurance, stamp duty, capital gains. Big one being capital gains that's made landlords sit up. And then from your experience at chatting to landlords, you're saying, take a look at your portfolios,
cleanse them if needed, prepare to reinvest in 2025, and think about limited company and tax structures.
Yeah.
Anything else to say, Nad? Any other tips for next year?
I mean, some of the common questions we get asked all the time is about timing, because we know that the budget announcement is going to be at the end of this month.
Yes.
And capital gains tax is the biggie, and it's a transactional tax, which means they can potentially change it the same day without them causing too much of an administrative. When I say them, the government, causing them too much of an administrative burden. So they have had history in terms of changing rules partway through a tax year.
Yes.
Although likelihood is that if they do it, be post-April, and that's even if it does affect the property rates ultimately. And don't forget, there's
what would that do? Sorry to interrupt. Because if you think about the market, so if they said actually we're not going to change this till April,
yes, exactly,
we're going to see what a lot of landlords exiting.
Well, this is it. So unfortunately, if anything was to happen 30th of October, it doesn't give us much time to do much now anyway. But if the government did give you till April the 5th next year, you will see a shift in people's kind of selling patterns and in terms of what that means in the market.
Yes.
And there's rumours that there's a reason why the government are doing that, because they want to inject a bit of pace into the market in terms of it there being a bit of a seller's market.
Right. Okay.
So great time to be purchasing, potentially, if you're out there looking in the market, because there could be a lot more property that's on the market over the next sort of 5-6 months.
Yes.
Again, this is all if it happens.
It's not a great time to sell, though, is it? Even if you're not a landlord, but if the market's suddenly going to be flooded with landlords exiting the market, I assume that's going to put downward pressure on prices in the short term.
Yeah,
which is great if you're looking to invest in 2025. Let's be fair. That's
I mean, we're really positive about 2025 in terms of what it means for the property sector in general, because we've heard lots of things about interest rates going down to potentially about 3.75%, and we're in line for that with inflation as well. So. And property prices the same, the 5-10% this time next year. So there's not going to be a slowdown, certainly. And of course, if there are more landlords exiting and re-entering the market, it's just going to fuel the market even more so. So it's going to be an interesting time. I think it's going to be a positive time for landlords. And just what I always keep saying, one step ahead, take advice, make sure you know what you're doing, and have your right things, have your ducks in order, basically.
Great stuff. Thanks, Nad.
Yeah.
That's everything for today's episode. Just a quick reminder about how Nadeem and his team can help you. If you need tax advice, head over to the Provestor website and you can book a call with Nadeem's team. If you think about starting a limited company, that's something we can absolutely help you with, including our low-cost service, $14.99 a month, get your company set up and get your accounts and returns done as well. As I said before, any questions in the meantime, put them in the comments below and we'll try hard to answer them. Whilst you're there, subscribe and hit that bell button, because in the next few days, the budget will happen and we will follow up with a more in-depth budget analysis and very specific guide on what you can do as a landlord as we move into 2025. So make sure you subscribe and be the first to watch that episode. Thank you for watching, and we'll see you next time.